Ever since I started trading and investing, my friends and colleagues have been asking me for recommendations to buy stocks. But I never recommend them any stock. Rather, I ask them to do their own due diligence before investing. In this video, I am going to tell you why I never recommend them any stocks and also share with you glimpses of the process that I follow to find investment opportunities. Before we start though, if you are new to our channel, please consider subscribing to get notified whenever we upload a new investment related video. So let's get started. First, let me answer why I never provide any recommendation. Princeton University professor Burton Malky, in his 1973 book, A Random Walk Down the Wall Street, mentions that a blindfolded monkey throwing darts at pages of financial papers can select a portfolio that would do as well as the one carefully selected by experts. Many studies back this statement that blindfolded monkeys, or more precisely, randomly selected portfolios, can outperform the one carefully selected by the experts. Now, does that mean you should just pick the stocks randomly? I won't recommend that either. But if you are going to put your hard-earned money in a stock just because an expert told you to do so, you would be better off with random stock selection. Markets are driven by investor sentiments in short term. So it is impossible to predict the short-term price fluctuations. Of course, there are certain tools that the traders use to predict the short-term price fluctuations, collectively called as technical analysis tools. But remember the fact that only 1 to 2% traders consistently make a lot of money. I am sure you must have heard about billionaire investors such as Warren Buffett or Bill Ackman. But have you heard about any billionaire trader? Exactly. That's the reason why you will find so many online and offline courses on trading, because it is easier to make money by selling these courses rather than actually trading. Over the long run, stock prices are driven by fundamentals only, and thus a carefully selected portfolio will outperform a randomly selected portfolio. But does this mean that if I'm a long-term investor, it is safe to invest in a stock recommended by an expert? No expert is perfect and markets are dynamic. Experts usually invest in large number of stocks, and so they would be more than happy even if 50% of their recommendations give exceptional returns. So unless you are investing in every single stock an expert has invested in, you are essentially risking blindfolded monkey situation. A simple solution to this dilemma is to understand some of the tools that these experts use to identify potential investment opportunities, collectively known as fundamental analysis tools, and identify the investments yourself. In this video, I am going to introduce some of the fundamental analysis tools that I use. If you want me to make a detailed video on fundamental analysis with examples, let me know in the comment section below. Now, there are two fundamental methods to analyze the stock of the company: quantitative analysis and qualitative analysis. In quantitative analysis, we study the factors such as balance sheet, income statement, and cash flow statement to determine the fair value of the securities. In qualitative analysis, we study the factors such as how strong is the business model of the company, does the company have any competitive advantage, do you believe in the management of the company, or how the corporate governance works in the company. Also, there are several other factors in qualitative analysis such as market share, potential growth, potential competition, or business cycle. In quantitative analysis, I look for certain signs of potentially attractive companies. First thing I check is the income statement of past 5 to 10 years. You can easily get this data from online sources like Yahoo Finance. In income statement, I first check the bottom line, which is nothing but net income. Net income of a good company should highlight steady growth. After checking the bottom line, I calculate gross margin and net margin, which is nothing but ratio of gross income to revenue and net income to revenue respectively. Companies with gross and net margin above 40 and 20% respectively definitely attract my further attention. Next thing I look for are the balance sheets, which are also available through free sources like Yahoo Finance. The first thing I check is retained earnings, which is nothing but part of earnings that company reinvests in future growth. A steady rise in retained earnings indicates that the company wants to grow further. Next, I check how efficiently the company is utilizing the retained earnings by calculating return on equity, which is nothing but ratio of income reported in income statement to the total equity mentioned in balance sheet. Personally, I consider higher than 20% return on equity as a good indication of efficient utilization of retained earnings. I also prefer to see a very low ratio of debt to net income. After checking balance sheet and income statement, I look for cash flow statement. Using this statement, I calculate ratio of capital expenditure to net income reported on income statement. Personally, I look for lower than 25% value. Another thing I do calculate from income statement is augmented payout ratio, which is nothing but ratio of sum of dividend paid and cash from repurchase to net income. This indicates how much earning is company distributing to its shareholders. Once I complete quantitative analysis, I start qualitative analysis. The first thing I try to understand is the business model of the company and try to identify whether the company have any competitive advantage. For instance, a company might have excellent brand recognition across the globe, or they might have a technology which is protected by IP. Company might also enjoy monopoly over a segment, or they might just have first movers advantage in the competitive market. Sometimes the products have cultural resonance or an element of nostalgia around them. I also look for barriers to entry for potential competitors. You can also get some qualitative information by comparing quantitative measures such as gross margin, net margin, and return on equity with industry average. Now we have completed our basic fundamental analysis. A good company based on basic fundamental analysis doesn't always mean a good investment. You need to calculate the fair value of the stock based on various methods, which I will discuss in the next part of this video. So don't forget to subscribe so that you will be notified when that video is published. Once you identify the fair value of the company, and if the company's stock is trading at a price lower than the fair value, you can consider investing in that company. Of course, you would ask, when should I sell it, right? If you have done proper due diligence and nothing has changed fundamentally, then there is no need to sell the stock. However, you can consider selling it if a better investment opportunity arises, or for some reasons the company loses its competitive advantage, or if the stock starts trading at a price much higher than the fair value. If you like this video, don't forget to smash that like button and share the video with your friends and family. Soon we are going to start to make videos on fundamental analysis of different companies. So let me know in the comment section below which companies you would like me to cover. Thank you.